This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at artificial intelligence and the role it can play in shaping the future of e-commerce.
Plus, while the U.S. Inflation Reduction Act looks to prop up clean energy ETF flows, does it go far enough? We'll take a closer look.
But first, we got some housing data out this week, and none of it is really good. You have rising mortgage rates, and affordability, particularly for the marginal buyer, is really plunging. So what actually winds up happening here? What's the bottom in the housing market? So let's bring in Bloomberg Intelligence analyst Erica Adelberg to discuss. Erica, so how unaffordable are prices right now? And is it due to the actual home price or mortgage rates?
Well, actually, the unaffordability is a component of both. It has to do with the fact that housing prices have risen as much as they have, but also mortgage rates have risen as much as they have. And if you take out the rise in mortgage rates, homes would actually still be technically affordable. And when we're talking about that, we're talking about comparing the qualifying income that you need to buy a median priced home to your median income. So, technically a lot of people would still qualify, but with mortgage rates having gone up almost double this year, it's really raised their payments, which has made their median payment at this point above what their median income is, according to the way it's calculated from NAR.
All right. Now, one of the things I don't understand here is just, I know that mortgage rates went up after being very, very low for the longest time because interest rates went up. We had the 10-year, 330, 340, but now the 10 years come back down. Mortgage rates haven't come down that much, have they? Is that just the stickiness of the mortgage market?
They probably still have room to come down a little bit if you look at the spread of mortgages, the yield versus the 10-year. And one of the reasons that widened out is because the Federal Reserve is also at the same time trying to reduce the size of its giant portfolio that holds of mortgage-backed securities. So the spread between mortgages and treasuries has widened. And frankly, the spread between primary and secondary rates is pretty high because mortgage originators are actually hurting a little bit. There's fewer loans to be made. So they're actually trying to regain some of that margin, as well as the fact that there's a little bit of risk and volatility in rates these days by having a pretty wide primary-secondary spread. So that could widen a little bit. But mortgage rates are well off their highs. I mean, they capped above 6%. And depending on whose series you're looking at, I think Freddie Mac came out at around 532 or something this morning. So okay. They're lower.
So based on that, are we looking at a crash? Okay, many seem to think we're going to have a terrible housing market, but no one seems to be looking for the 2008, 2009 scenario. What do you see, and what's the distinction?
I'd say the biggest distinction for me is the fact that right now homeowners own so much of the equity in their homes because prices have risen that much. And so at this point, I was just looking at the numbers before I came up, they own about 70% equity outright on their homes.
Oh, interesting.
Yeah, so the much lower risk relative to their homes. What happened back in 2008 is a lot of people actually went underwater. Not everybody, but a lot of people were underwater. So they actually owed more on their mortgages because housing has started to come off than the value of their homes. So they just walked away. And one of the reasons that happened is because there was so much subprime lending and high, these types of high risk mortgages where the payment would actually go up if people just felt like not paying. So as a result, people's LTV, loan to value, was actually above the value of their homes. And I say they just walked away.
How about some regionality of this analysis here? It just seems like we're hearing it was always the coasts that were really expensive. But, during the great migration, I guess, during the pandemic, we heard stories of everybody's leaving the coast. They're going to Austin, Texas, Nashville, Tennessee, wherever. Are you seeing that in the affordability?
Actually, surprisingly, maybe not surprisingly, California is still by far the least affordable area in the country. The least affordable. And it's just because home prices there are so high.
Okay.
But that being said, there's definitely a flattening of the affordability curve. There are other places that were very affordable that are less so. And part of that's because there's a lot of investors coming in, buying up the homes and renting them back out.
So what's the biggest crisis? Is it housing crisis or a rental crisis? Like where is going to be the biggest mismatch going forward? They both seem pretty bad to me.
Yeah, I mean, I don't think because of the amount of leverage that people don't have in the system this time, I don't think it's going to create a crisis in the sense of 2008.
No, I mean like crisis, just like it's just really hard for people to manage one or the other.
Yeah, I think it's gonna. I think people are not able to live in all cases where they work, and not all people like services people can do remote work.
Yeah.
And so I think that's one of the reasons I think that. They're just not going to be able to get the types of rents they want. People are going to have to move further and further. I mean, there's a lot of knock-on repercussions. It's not great for our environment if people have to drive, 60 miles. So I think ultimately we have to build more sustainable housing closer to urban centers, for instance. And I've read a lot. That probably means some zoning has to change. Some of this NIMBYism has to change because people want somebody to help man the restaurants and clean their homes, but they don't want people to live near there.
That is a great statement, actually, and entirely true. And you're completely right. Particularly New York City, living here, it really hits home the housing crisis that we have. Erica, thanks a lot. We really appreciate it. Erica Adelberg of Bloomberg Intelligence analyst.
Coming up on the program, clean energy flows may be on the rise, but will it be enough to boost ESG and sustainability?
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, now let's talk ETFs, particularly ESG ETFs. They've been such a popular part of the market for a long time. The question is, can it continue? Let's bring in Bloomberg Intelligence analyst Shaheen, Contractor. So Shaheen, I mean, ESG ETFs were so hot for so long, but now I'm starting to see some data that's not so good. Just give us an overview what you're seeing in the ESG ETF space.
Sure, Paul. So first, you're right. It was so hot last year. For example, just in the first half of last year, it was about 87 billion in flows, and this year we're about 33 billion, so quite a steep fall. I have to say, though, last year was the sort of high watermark, right? Clean energy really uplifted all the flows, was about 30% of the total ESG sustainability category in January, and that sort of retracted, and we're seeing quite a bit of a slowdown, but it's really concentration risk. The outflows are limited to a few funds because the inflows were limited to a few funds.
So I feel like in part there was a big move into ESG, in part I say, because President Biden was elected to the White House because he was going to have this huge green energy plan. That didn't happen. We've got a type of green energy plan with the Inflation Reduction Act. What ETFs would that be good for? And have we seen the flows to back that up?
Sure. So clean energy particularly. But last year, yes, when Biden did come into power, clean energy flows shot up. They went from something like 800 million in 2019 to compare to 10 billion. So billion.
Oh my God.
And now that's sort of retracted. So, Paul, that's what I meant by it's supported. And basically, the way we think about it is, because of Biden's climate agenda, everybody may have expected this, and the flows, came last year, might not come again so soon because of this.
All right. Is the flow issue, it seems like ESG investing, it's more popular or more closely held in Europe than it is in the U.S. Are we seeing different paces of flows between those two markets?
The U.S. really shot up last year.
Okay.
And Europe has always been catching up. Yeah. Yep. And Europe's always, in the sustained sort of, uptrend. I have to say the US sort of crashed and burned this time, and Europe Europe was much stronger. It fell as much as broader ETFs, but the US fell much faster, and that was that very concentrated flows that came out.
Matt Miller from Bloomberg Radio and TV, we interviewed a guest a couple of weeks ago who launched an ETF. It's not an anti-ESG ETF, but he's saying basically, I'm going to put companies in there, including energy, that make money. ESG should be policy, not investment. Is that a belief that's kind of growing out there, do you think, in the ESG community?
It is. It's called the whole anti-woke ESG campaign. I mean, I have to say, ESG is it's not so much about policy or your beliefs or your ethics. It's just a type of analysis. It's analyzing companies beyond just their financial indicators.
To be sure, though, it usually winds up mostly being tech in some capacity. So she's sort of shaking her head.
It is.
So I'm just wondering, is there a way where that definition gets broadened out a little bit? Because when you have a sell-off like we had in tech this year, you're going to have ESG funds take a hit, even if it's not a perfect line.
So that overweight tech is a fair criticism, I have to say. I feel like ESG is about sort of a company analysis. It's not about some kind of sector skew where you just buy one sector and you sell one sector. So that is a fair criticism. I do have to admit that.
Do we have an oversupply of ESG ETFs out there?
We have an oversupply of climate ETFs out there.
Climate
very much. To put into context, last year there were about 180 climate ETFs versus about 30 in previous years, and this year we're already about 60.
What kind of climate ETFs are there? How would you even think about investing in them?
So I think of one as sort of adaptation. That's clean tech, clean energy, electric vehicles, hydrogen maybe. And then there's a little bit of mitigation is the wrong word, but it's sort of low carbon, fossil free. Those are sort of a little more market trackers, right? They'll track the market, remove just the fossil fuel exposure. And then the others are pure clean tech kind of thing.
I see.
Clean energy.
How about thematic ETFs? Are they more expensive to kind of run, or do I see that in the fees? How does that work?
Very much so. So if you think about simple concepts like low carbon, I just have to screen my portfolio for carbon intensity, remove the simple ones. So they end up being cheap. But if you consider something like the Sustainable Development Goals, that's a lot more analysis. So it just results in being a lot more expensive.
So what do you think is going to be the next catalyst for this group? Because clearly it feels like the direction of travel is everyone has to own a part of this in some capacity in their portfolio. It's like a hedge, no matter what. So what's the next catalyst going to bring more people in?
The big catalyst right now is the regulations in Europe and rebranding of funds. So there's so many funds that have just gone from non-ESG to ESG, and because their assets just keep getting added, right? It's not organic assets, it's a movement of assets. So that's been a huge catalyst right now.
I'm looking at your chart. This is ESG fund flows by domicile for the first half of 2022. Obviously, Europe is the main player. North America is there, but kind of the rest of the world, like Asia, not so much. Our good friends in Japan, not so much. If I go to Asia, or if you go to Asia and talk to Bloomberg's clients in Asia, can you get any meetings?
Actually, it is rising quite a bit. We were in London early this year, and there was a lot of Asia interest. I think it's sort of upcoming. In China, there's a lot of clean energy type ETFs, and the flow is sort of move in and out, just like any kind of clean energy sort of speculative market.
If we just do clean tech for a second, is there an area of clean tech that does better in terms of flows or outperformance?
It really depends.
If it's are they as specific as we're going to remove carbon dioxide from the air and put it into the ground, or is it here's the new cool solar technology kind of thing?
So it's broad. You can have a broad-based clean energy, which is takes on different themes. You can have very specific ones like hydrogen ETF, specific ones like those on carbon commodities. So they track the carbon price in, say, Europe or something like that. So it's really thematic. It depends on the market. Carbon ETFs, those that track carbon prices, they sort of skyrocketed last year at some point.
All right, Shaheen, I need to get my data quality question or data availability question for ESG because, at least when we started doing it at Bloomberg, there was a real dearth of data out there for analysts and investors who wanted to do some real analysis and looking at environmental, social, and whatever the G is, governance. How is that data availability, quantity, and quality out there if I really want to do some analysis?
Yeah, so it's the governance data has always been there. It's been pretty great in quality and quantity, so that sort of stayed the same. I think when it comes to emissions, that's increased quite a bit. In terms of disclosures, that's increased too quite a bit. I think right now there's so many kinds of products that manipulate that data.
Right.
That's really what's going on in the market.
All right, good stuff, Shaheen. We really appreciate it. Shaheen Contractor. She covers all things ESG for Bloomberg Intelligence.
All right, coming up on the program, we look at the integral role that artificial intelligence may play in the future of retail.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
This week was a big week for certain retailers, from Walmart to Home Depot, Lowe's, and Target. But walking it forward, no matter what their profit margins are going to be today, artificial intelligence could make their profit margins that much better in the future. So let's take a look at retail from that lens. And joining us to discuss is Poonam Goyal, Senior Industry Analyst for Bloomberg Intelligence, who covers retail. Poonam, betting on the future for these guys, regardless of where inflation is today, is critical. How does AI feed into this?
Yeah, I think AI is actually at the core of this. So everything that we do today, if we want to do it better, we need to use the underlying data that's given to us from the consumer, from our operations, to really go back and make improvements, improve processes, improve customer satisfaction, and even improve conversion at the onset of everything. If you can analyze the data that you have at your fingertips, which today we have so much more than we ever could have asked for, we can really make meaningful improvements to online conversion rates, which, as you know, are in the low single-digit rates. And just integrating AI personalization and doing it well can drive a 10 percentage point increase in those conversion rates.
You know how cynical I can be, Poonam, and I kind of think sometimes as I listen to earnings conference calls that every single CEO talks about AI, and I think it's just for them to get their stock price up a little bit, maybe trying to get a tech multiple. All right, so explain to me how a retailer would use artificial intelligence to kind of increase I guess the efficiency of their business.
You're not a shopper, are you, Paul?
I am not a shopper.
Come on.
Is it just another email my inbox?
Okay, so there's lots and lots of different ways. See, that's the thing. When we talk about AI, we think it's one thing, but it's really not. It's many things. So an example that I really like, which I think uses AI and actually saves time, is something that Sephora does and L'Oreal does. So if you think about how women shopped for makeup, skincare in the past, you went to a store, you went to the counter, you spoke to a makeup specialist or a skincare specialist, they looked at your skin, and then they provided you with, okay, here's what works for your skin. Today, you go online, you go to scan the look, you scan your face, and using the data that they have already built into the system from millions of other scans, they can come back at you within seconds. Here's the perfect shade of foundation. Here's the perfect moisturizer that you need. And just imagine how much time that saved. But the key here is getting it right. And getting it right depends on having the data and have analyzed the data better to make sure that the output is actually effective and useful to the consumer.
So how much can that, because that's a great example, and there, like you said, there's lots of different ways, but if you use that example for a second, because I interestingly just did that, how much money then do they make off of me by doing it? Like, what's their margin on that?
Well, it depends on the product, right? So margins are surely a function of products. If you're buying skincare, the margins there are 70% plus.
Oh, wow.
If you're buying apparel, the margins, the gross margin, they're probably in the 30-40% range. But if you're buying food, and there are uses of food in AI too, the margins are still slim. But the key isn't margin here. The key is conversion. There are so many people that go online, go on their mobile devices and start scanning thousands and thousands of items, look at multiple things. But how many of them actually transact? And the reason they don't transact is because they're not seeing what they want, what they're searching for isn't coming up with the right result. And when they ask for a black dress to wear out, they're getting a black dress to wear to the beach. right? So AI is what improves these results. And as you improve results, as you tailor web pages to match the preferences for that shopper, you're going to drive a higher conversion. And that's key for retailers. It's driving up the conversion.
Hey, Poonam, what we've heard from a lot of the retailers over the last several quarters is inventory imbalances. I would think improved data, improved analytics, maybe even that AI catchphrase may be applicable to managing inventory better.
Yeah, absolutely. Huge for inventory, actually. One of the biggest problems, as you said, Paul, is inventory. And right now we're seeing it. Since the pandemic, retailers and brands ordered so much inventory because of the delays last year and the year before due to the pandemic that now they're having to clear it out and they have too much inventory. So how can AI help with that? Well, it can, because if you have the right algorithm in place to match demand with supply, then that means you can better order inventory. And there's another interesting way in which inventory can be managed and have a long shelf life. And I like this example a lot. It's actually rent the runway. So if you think about retailers and the information that they have today, they have the information from when they choose the underlying material to when they sell the product.
That's great. I'm sorry. I was really into what you're saying. And I was thinking, too, it's like, because I left some Rent the Runway stuff in my closet. Really interesting. Poonam, thanks so much. I could talk to you for a while on this. Poonam Goyal, Bloomberg Intelligence analyst.
Coming up on the program, how will bonds hold up in the event of a 2023 U.S. recession? Tech and utility bonds may weather the storm, but industrial and retail companies could be facing a downgrade risk. We'll take a closer look.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Well, currently, there's about 40% odds of a 2023 U.S. recession. So Bloomberg Intelligence in the credit side did a deep dive and it went through the different sectors and did an analysis of what it would mean then for the investment grade, for the high-yield bond market, and different industries. So joining us now to discuss that survey, Himanshu Bakshi. He is Bloomberg Intelligence credit analyst. Broad strokes, what did you guys find out?
Thank you for having me. So since we published our report, actually, the odds of recession in 2023 has gone up to 50%. And so our team of talented analysts came up with a list of sectors and companies that may be most and least impacted in a recession. And based on our analysis, industrial and retail companies' bonds face downgrade risk, while technology and utility bonds may be most resilient. We also looked at energy sector, and what we found is that energy credit spreads will mostly be resilient unless oil prices fall below 75. And in the financials, which what I cover, we think that Bank of America and in credit card space, American Express will have lower loan losses than all the peers. And then in REIT space, finally, we think that Simon Property, because of its high quality malls portfolio, will be most resilient in a downturn.
All right, so Himanshu, you covered the financials. So let's start with the credit cards, because that kind of brings into the question the consumer debt. And right now, most of the data that we see, the consumer looks pretty good. I know the consumer has drawn down savings. They're starting to build up credit. How do you think this will play out for the credit card issuers in a recession scenario?
Sure. So exactly as you said, the consumers are pretty healthy even as of now. The metrics that we look at when we're looking at consumer health, first thing is we're looking at debt service capacity. And that's declining. And the reason is obviously we all know because of inflation. And the second thing that we're looking at, that savings is actually coming down and is now below pre-pandemic. So despite those two, we haven't seen any increase in delinquencies or past due loans. And so that's the metric that we are focusing on right now, because we do expect delinquencies to go up and eventually charge-offs to increase, but we think it's going to be more of a normalization than an asset quality deterioration. So that's our base case as of now. Even if we have a recession next year, companies like Capital One and Synchrony Financial may suffer more, have higher losses than Amex and, say, Discover, just because they have a higher subprime exposure.
Why?
Because
why do you think it's going to be okay this time around?
So in terms, if you just talk about charge-offs, we say that Capital One and Synchrony will have higher charge-offs just because of subprime exposure. But the reason we say all credit card issuers should be fine is because of two reasons. First, they all have higher provisions or reserves for loan losses. If you look at all the card issuers except for Amex, reserve levels for all card issuers are still higher than pre-pandemic. That's the first case. And then second thing we look at is capital. Capital is basically what the companies, what the credit card companies or banks have for unexpected losses. And capital ratios for all the card companies are way higher than how much the regulator require them to hold. And thirdly, if you look at the recent stress test by the Federal Reserve, all the card issuers performed really well in the stress test. So we don't see a bad impact on asset quality. We see more of a normalization just because how the card issuers performed in the stress test, even when unemployment went up to 10%. We don't expect unemployment to go to 10%. So yeah.
All right, so for the banks, switching gears to the banks, does that same logic kind of hold here? I mean, when I think of the bank space, it's obviously the big, what I used to call money center banks, diversified banks, and then the regional banks. How do they fare? Where are some of the risks? Who are some of the potential winners there?
So same thing we saw, if I talk about the stress test, we saw the same thing that most banks did really, really good on the stress test. And all banks actually passed the stress test. When I say compared better than the other, example would Bank of America. So what we saw was that Bank of America's projected credit losses were actually lower than the other big banks like JP Morgan or Citigroup or Goldman Sachs and other banks. So we think that even the losses, even for banks, not just card issuers, will go up, but we see it more of a normalization, going back to where the banks were during pre-pandemic and not worse than that.
I feel like there's got to be some huge risk in some sector. I don't know if we know that quite yet. All right, we're going to leave it there, but we're going to come back to this in time, I promise you. All right, thanks so much. We really appreciate it, Himanshu Bakshi, Bloomberg Intelligence analyst.
Thank you.
Well, it has been a risk-on feel to the market really since the beginning of July here. After a terrible first half of the year, a lot of folks are kind of getting back into the growth story. Is this a trend or not? Let's bring in Tim Craighead. He heads strategy for Bloomberg Intelligence. He's based in London. Tim, what are you seeing over there in the FTSE in kind of how investors are allocating their capital between growth and value?
Yeah, I tell you, Paul, it's been a massive turn of events from the standpoint of how the first half of the year was all about value as interest rates were rising, as inflation was a concern, and there was a flocking in towards the commodities, the banks, things like that. And since we've turned the corner, I think a couple of things have happened. Number one, 180-degree shift. Value has come back into vogue as interest rates have come off the boil. And I think that, similar to what you may be seeing there in the States, but across Europe and specifically in the UK with the FTSE 100, the 10-year gilt yield, the 10-year bond of the government, has pulled back from a 2.5% sort of peak back towards 2%. And with that retreat, the pressure on the growth side of the equation has come off. And so those stocks have just torn and value has sort of drifted.
When I think of growth and value in the U.S., if I pare it down, I think it's commodities, energy versus tech. Is it the same thing in the FTSE?
That's a really good question. Partially yes, partially no.
And that's a good answer.
The energy and materials, yes. The banks, absolutely. You think the FTSE has got almost 20% of the index in financials, and a big chunk of that are core banks. And it's got more than 10% of the index that's in big oil, basically British Petroleum and Shell. So wholly different than the little E&P companies you have in the U.S. Now, there's 1% of the index in the FTSE that's technology. That's it.
Wow.
And so the growth side for us are pharmaceuticals and consumer staples. So you think Unilever and Diageo, if you like your scotch, along with Reckitt Benckiser, and AstraZeneca and Glaxo. So that's our growth side.
Tim, I know we've got the factor investing, and that's a big part of how portfolio managers and asset allocators, think about their business. But we just got through with a earnings season here. How was it in the UK? How did the companies fare?
Yeah, it's interesting, Paul. We had a very different earnings cycle here than what you've experienced in the States, where my colleague there, Gina Martin Adams, is very clear in saying that we've already started an earnings recession in the U.S. Well, in the U.K. and more broadly across Europe, earnings actually came in much better than expected. Instead of 16% growth expected it to begin with, we ended up at like 24%. Wow. Two things have driven that. A big part of it is that big integrated oil exposure, and again, that's heaviest in the UK with high energy prices, et cetera. And another part that's true in the UK and for a lot of Europe is currency. You think the strong dollar in the US, that's tough for US global multinationals because you'd be importing in weak foreign currencies. Well, it's exactly the opposite here. If you think about the UK, the pound is down about 14%, 15% from where it peaked in 2001. The euro's down almost 20%. The Swedish krona is down like 23%. And that creates a bit of a tailwind from a currency perspective. Now, frankly, that could flip as we go ahead because currencies over here are on their knees. But that's another story.
Well, but I think it's an interesting point onto the correlation of FX and then the FTSE, which also brings me to the correlation between rates and the FTSE in that you have 40-year high inflation, but there is still a lot of question about what the BOE is going to be able to do. So just because you have this high inflation doesn't necessarily mean you're going to be able to have higher yields in the way that you might expect. What does that do to a company and their profit margins?
Yeah, it's really interesting on this point too, Alex, in that you think about the Bank of England or the ECB, Fed even, they can't affect the supply of energy. And over here, the big part of inflation for the UK, and again, more broadly in Europe, is about energy. And with that, the only thing that central banks can do is to clamp down on the economy to reduce demand so that there's a rebalancing of demand versus what supply is available. Mm-hmm. And then, you can let other parts of the economy, policy from fiscal or corporate perspective, try to deal with other supply sources to, boost that side of the equation.
Thanks a lot. Super appreciate it, Tim Craighead, Bloomberg Intelligence analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.